Good evening, ladies and gentlemen. Again, thank you for those of you who've already registered and are in the room. We're going to get started at 8:05. So again, if you just need to grab a coffee or a drink, you've got a few minutes to do so before we start. Thank you. Good evening, ladies and gentlemen. It's 8:04. We're going to start in just 1 minute, so please bear with us. We just got a few more people that said that they are trying to get into the waiting room and then into the webinar. So we're going to start in 1 minute at 8:05. Thank you. Good evening, ladies and gentlemen, and thank you again for registering for our webinar tonight. The topic being the London Property Rebound. Are you ready to ride the wave? And I'm delighted to be joined by Colin Walpole, the director in Singapore for Life Residential. Life Residential manage over 4,000 properties, particularly in London. And what we're going to be covering today is really an update of what's happened in the London real estate market, particularly since Brexit. The market was very subdued for 5 or 6 years. But what we've seen really in the last sort of 6 to 9 months is a huge rebound and interest in the London property market, which is resulting in prices really starting to show the early signs of acceleration, as well as a rebound to people working in the office space in London, and that's been reflected in rents really rebounding extremely strongly. So these are some of the key areas that we'll be covering tonight. And again, if you're wanting to learn a little bit more about what's been happening in the London property market, you're in the right place. So without further ado, I'd like to hand over to my colleague and co-host tonight, Colin Walpole from Life Residential.
Good evening, everybody. Thanks very much for joining this evening's webinar with myself and Richard. It's good to see everybody online. As Richard mentioned, my name is Colin Walpole, and I'm the Asia Director for Life Residential here in Singapore. This evening, I will speak briefly about Life Residential and our services, and I will also speak to you about the London rental market and the rebound in the London rental market post-COVID. So as I said, I'll just give you an introduction to Life Residential, the services that we offer, and then a London rental market overview. I've been based here in Singapore for approximately 7 months. Our operation has been running here in Singapore for 7 years. We're based close to Somerset Station, and I'm also assisted here in Singapore by our client portfolio manager, Anna, and she's been with us now for a period of 5 years. The reason why we're based in Singapore is because we have a large Asian client base, and we feel it's appropriate to have a base in Singapore to make sure that our clients have a support network, primarily due to the time difference between here and the UK, plus the fact that we're able to meet with our clients face to face and provide an extra level of service. This next slide, now this is a list of our USPs. I won't take you through each and every one of them, but I'm just going to point out 2 or 3 that we feel are very important. As Richard said, we manage a portfolio of approximately 4,500 units across London and Birmingham. We have international offices in Singapore and Hong Kong. One of the key SOPs that we're very proud of is our current rent arrears. As you can imagine, managing a property portfolio of approximately 4,500 units, our rent roll runs at approximately £18 million per month. And we can manage a rent arrear percentage of approximately 0.13% of our total rent roll. And that's primarily due to our strict qualification of applicants and the thorough referencing process that we put our applicants through before they take possession of our clients' properties. We have an in-house completion and handover team. So for those of you who may be considering purchasing a new investment in London or Birmingham, we have our own in-house completions team who will deal directly with you and the developer in terms of key handover, any furnishing requirements, any defects that need to be taken care of. And the primary reason for that is just to ensure, hopefully, that it's as stress-free as possible for you, the client. And one other one, you as a landlord will have your own bespoke landlord portal, and that's to ensure that you have access to all details relating to your property 24 hours a day, 7 days a week. And we've currently dealt with approximately 25 to 30,000 tenancies during our time in operation. This next slide is just to provide you with an idea as to our branch network across London. And we've recently also opened our branch in Birmingham. And as mentioned previously, we also have an office in Hong Kong, which is headed up by my colleague, Patrick Kennevan. As I've mentioned, just in one of our USPs, our pre-completion services, as I've mentioned, is purely to make sure that the whole process between completion and handover is as stress-free as possible for you, the client, and we take the work on board for you, again, just to make sure that it's as less stress as possible is placed on you, the client. We also have a full letting. We are predominantly a letting and management agent, so we provide you with a full range of letting services from the day that the keys are collected right up until the day that the tenant takes possession of your property. And we also deal with any renewals that need to take place on your property on a yearly or bi-yearly basis. We also have a range of management services. You would be assigned your own property manager, and they're your point of contact between you and the tenant. So you would never have direct contact with the tenant, and we deal with all and any inquiries that come through from your tenant. And we also make sure that we're up to date with any legislation and compliance changes that are occurring in the property industry. We also have an asset management team, and they will conduct periodic inspections of your property, and we will provide advice to you on how to best maintain your asset and in turn maintain the capital and rental appreciation on your property. Our accounts team, you'll also be assigned an account manager, and they deal with all financial related managers on your account. We also have a full sales team So should you ever be thinking about selling an asset, we can provide a bespoke, full in-depth sales valuation of your property. And we also have an in-house sales progression team, and they will deal directly with both lawyers to ensure that the chances of the sale falling through are kept to an absolute minimum. The next slide is just some of our recognitions. We have a 5-star rating on Google, a 4.5-star rating on Trustpilot, and we've just been awarded the award from the Best Estate Agent Guide in conjunction with Rightmove for the best medium-sized letting and management agents in the whole of the UK. Now, the next slides I'm going to take you through are 3 new developments in London. And the slides I'm going to show you is how the rental market is performing in that particular area where these new developments are and how they're comparing to prime central London and the greater London area. This development happens to be a Barratt development in East Ham in a development called New Market Place. And the orange bars are how the rent trends are in that particular segment of E6 in East London compared to prime central London. So you will see this is based over the last 6 months. So you can see from this graph that studios, 1 beds, 2 beds, and 3 beds are pretty much performing in line with the greater London area. So demand for rents or rental properties in this particular area of East London is very strong at the moment. This next slide is for a new development in West London, close to North Acton Central Line Station. It's called 1 West Point, and this development will be completing towards the end of this year. It's an amazing development. It's called a placemaking development, whereby the developer will develop a community and encourage a community on site to encourage tenants to stay longer. So there'll be a range of facilities on site like gyms, bars, restaurants, and other services like creche, dry cleaning, and those type of services to encourage people to create a sense of community and to stay in the development long term. Again, this graph is based over the last 6 months, and you can see from studios right up to 3 beds, again, that this particular area of West London is performing in line with the greater London area. This next example is called Graphite Square. It's in southeast London. And again, this range of rents is taken over the last 6 months. And you can see, in fact, that studios, 1 beds, 2 beds, and 3 beds are actually outperforming prime London and the greater London area. So there is very, very strong demand for this particular area of London. Now, again, that's just an example of 3 developments in different areas of London: southeast, west, and east London. And it gives you an idea as to those particular postcodes are performing in the London market. Now, next I'm going to take you and discuss the London rental market review with you and how it has been performing pre-COVID and post-COVID. So this is the current market overview for London. You'll see that pre-COVID, my apologies, and during COVID, supply greatly increased throughout London. Demand greatly decreased, which had, unfortunately, a negative impact on rents, because unfortunately, people were leaving the greater London area to return to their home countries or to return to their home cities in London due to COVID and maybe being placed on furlough and having to leave the city. Move on then to Q4 of last year and moving into Q1 of this year. Supply across the whole of London has greatly decreased. Demand has greatly increased, and now we're seeing record rents being achieved across London. And if you see the bar chart to the left, specifically for September of last year, and this was taken over a 3-year period, we had a record year for move-ins over 21 years of business. So demand was extremely high. It's continuing to be high, while supply levels across London continue to be low. This next chart is to provide you with an idea as to where we are for average rents across the Greater London area. Now, this is across a portfolio of 4,500 properties, and it's an average of the rent across the whole of that portfolio, right across London. But it's just to provide you an idea as to where the rent levels were pre-COVID, what happened during COVID, and now the rebound that we're seeing in the London property market post-COVID. So approximately March, April 2020, we were achieving an average rent of 1,760 per month on average for across our total portfolio. Then COVID hit and rents dramatically decreased across London to August 2021. We were achieving an average rent of 1,587 per month. But in the last 6 to 7 months, you can now see the upward trend and the recovery in the rental market in London, where we're now seeing an average rent as of March 22 of 1,669 per month. The next chart is just an idea of vacancy and how the vacancy rate was affected during COVID. On average, before COVID, our vacancy rate across the whole portfolio was running at approximately 40 units. Then, unfortunately, COVID hit in March 2020, and that figure increased to a peak of 209 units. So you can imagine there was great pressure on rents in the London area, and unfortunately on our client base, where we were struggling to rent our units. Then over the last 7 months, you can see now that it has dropped to a figure as low as 17. And now there has been a slight increase over the last 2 months, because we have just launched a new development with approximately 300 units. So it has increased supply in that particular area and has increased our vacancy rate just for a short period of time while we wait to rent the stock in that particular development. But on average, our vacancy rate runs at approximately 30 units across the portfolio. So this is just an idea as to what our expectations are over the next 6 months. We are expecting a continued restriction of supply of quality stock across London. We are certainly not expecting stock levels to increase in the medium to short term. We are continuing to see the return of employees and students to London, which will maintain demand levels and continue to increase rents across London. And just one example, already, this is May of 2022, students are already beginning to inquire about stock in London for the return to university in September and October, because there was such demand for stock last year. Students don't want to be missing out this year, so they've already started to inquire. Because of the shortage of stock in London, we are now able to negotiate longer leases. So the absolute minimum that we're negotiating at the moment is 1 year. We're pushing this now towards 2 and 3 years. And the benefit of this is that it's providing consistency and longevity of tenancies and reducing our landlords' costs. Tenants are wanting stability of longer term leases also due to the upheaval of COVID-19. and tenants and landlords are seeking to work with reputable letting and management agents as the industry evolves and compliance becomes stricter within the letting and management industry. What we've also seen, a change of lifestyle due to COVID. There's now a demand for quality built apartments with outdoor space, units with balconies or terraces, and developments that are close to communal areas will continue to be popular to match tenants' needs and wants. Whereas before COVID, number one priority for a tenant would have been to be close to public transport, and the proximity to open areas may not have been as high. We've now seen a switch in that lifestyle, where now tenants want larger units with outdoor space, whether it be balconies or terraces, but they also want to be closer to large green spaces, and the demand or want or need to be close to a tube station or rail station has dropped down in their list of priorities. So that's our medium to short-term outlook for the London rental market. We're projecting that over the next 5 years that we're going to see rental growth across London of approximately 5% per year. So I'll be happy to answer any questions at the end of the webinar. I'd like to thank you all very much for listening, and I'm now going to hand you over to Richard, who will enter the next topic of the discussion. Thank you very much for listening.
Okay, thank you very much there, Colin, for giving us a great overview of the rental market, of the London property market. Again, for those of you tuned in a little bit later, my name is Richard Lowe. I'm the director for One Global for our expat division, and I'm going to be taking you through an overview now to the London and UK property markets. So just before I do that, for anybody who's new in this webinar today, and it's the first time for them to learn about One Global, just a quick introduction. We're headquartered here in Singapore, but we have offices in various parts of the world, which I'll show a little bit later. We do have a local sales and leasing and commercial business team here in Singapore, so we can support people looking to their real estate needs in Singapore. Our strongest markets are the UK and Australia. We are members of the leading real estate companies of the world and luxury portfolio, so we can access many different organizations around the world in case you have real estate requirements in countries where we don't have such a strong presence. To date, we have about 50 staff, but that seems to be growing every single day. But I think really one of the key value adds that we provide to clients, particularly for those who are looking to invest in overseas market, is really addressing the fear of the unknown. And very often a client may be concerned to invest in a country that they either haven't traveled in before, are not familiar with, not sure whether it's going to be a good place to invest or whether it's the right place for them. So we take clients through a complete end-to-end service, and this will start with our research division called One Global Labs, who do an enormous amount of research to really find areas which will outperform and provide our clients with above average returns. So it starts with due diligence and looking to do intensive due diligence, typically looking at a variety of things like population growth, infrastructure improvements, the economy, and where we see neighborhoods which are going through this regeneration and population growth, you'll typically find that is an area that will see a disproportionate increase in real estate values. And so we'll very much zoom in on that neighborhood. We pride ourselves on working with some of the top developers in the world, and many of them are public listed companies who could choose to work with almost any real estate agency. So we're honored that they work with One Global. We have won various awards, as you can see at the bottom of this slide, in the Asia Pacific region. But once somebody's decided to invest, the journey really starts there. We literally guide a client through the whole A to Z of the investment life cycle. So selecting the right property for your investment portfolio, acquiring that property will usually start with an introduction to a lawyer. We have mortgage brokers that we work very closely with to assist with the financing. We work closely with Life Residential, Column obviously here in Singapore, to be able to help people in this part of the world. And when it comes to completion of the property, this is when we hand over to the likes of Column and Life Residential, who will do a full handover from the developer, market the property, find the tenant, manage the property on a day-to-day basis, collect the rent, even through to the point of reselling the property when you wish to exit and take back your profits. So it really makes the whole process as smooth and as hassle-free as possible. And if you do have a challenge, then you know you've got somebody there to guide you through to find a solution to that challenge. We do also have a private office team, which is a different department that assists people who may be looking for a bespoke search for a property of £2-3 million or above. It might be a family office or an institutional investor who wants to buy a building or a student accommodation or a portfolio of properties, or even joint venture and become a developer themselves. So there's a variety of services that we provide, and I hope that gives you some overview to the kind of services that we can offer. So just moving to the next slide. Sorry, it just seems to be stuck at the moment. Sorry, if you can just assist with helping to move through to the next slide. So the next slide is actually showing our offices. As I've mentioned, we are headquartered here in Singapore, but we, you can see from here, have offices in Hong Kong, Kuala Lumpur, Dubai, South Africa, and we are opening up in the UK as well. So these are the offices we have. We've grown from a Singapore company to now a global company in a relatively short space of time. Next slide. So let's get into the actual meat of the presentation. The next few slides, I'm really just going to go over some macroeconomics to get some context and background to the UK property investment opportunity. Now, I've lived in Singapore since July 1995, so it's coming up to 27 years. And I remember when I first arrived here, the exchange rate was about 2.5, 2.6 Singapore dollars to the pound. You can see today, in fact, I was looking today, it's about 1.7 Singapore dollars to the pound. In fact, if we take this graph back to about 2007, the exchange rate at that time was at about 3.15 Singapore dollars to the pound. So what we can see in this is that the buying power of the Sing dollar against the pound sterling has hugely strengthened over time. In fact, there's been some real landmark changes. In 2016, soon after the Brexit referendum, we can see that the exchange rate went from just under 2.2 and dropped at one point to about 1.68 Singapore dollars to the pound. So it dropped at almost 20% within a few months. And when we look at this drop in 20%, and in fact, since 2007, almost 30% drop in value of the pound sterling against the Sing dollar, it really does represent almost like a 30% discount in terms of the ability to buy the same property with Sing dollars, but at a 30% discount. So exchange rate is always important when you're investing into an asset class in a foreign currency. And certainly in the 27 years I've been here, it is arguably the best time from a currency FX play to be investing into a UK asset. Next slide. So one of the key things that impacts real estate capital growth as well as rental growth is supply and demand. And those factors are really influenced by how much property is being supplied into the market and what is the population growth of that particular country or city. Now, the government has recently estimated that the UK, just to be able to maintain the supply-demand balance, needs to deliver 300,000 units every single year. Now, this graph goes back to 2000, and I had a previous graph that went back to 1989. And not one year has the UK been able to deliver that 300,000 mark. So over time, the situation is actually getting worse rather than better. And until the UK can find a solution to being able to deliver more than 300,000 to be able to catch up this huge deficit, there's going to be an underlying or undersupply of property, which is great if you're an investor and a landlord because it continues to help drive up prices, but not so good if you're a first-time buyer trying to get onto the UK housing ladder. Now, here we actually see the average property prices in the UK going back to 2005. And if we extrapolated this even further back into the 1960s when records began, the line would be pretty similar. Now, what we do see is that in 2008 to 2009, we see the biggest drop in house prices in the UK since records began. Simple explanation, that was the global financial crisis, significantly driven by real estate, particularly in the US, but it had knock-on effects in many countries around the world. And in the UK, prices dropped by about 18 to 19%, which is the biggest drop since records began, but by no means, compared with many other countries, quite as dramatic as other countries experienced. But we can see that the market quickly started to recover. And if we fast forward to present day, what we're seeing is that the line or the increase in prices is actually accelerating. And I'm going to go into a little bit more detail of why that has occurred. Now, this breaks down the UK by region, and we can see that the different regions based on February 2021 to February 2022, the average increase in property prices in those particular regions. 2021, the overall average of price increase in the UK was about 10.2%. And we can see that obviously some regions have performed slightly higher and some slightly lower. It's interesting when we look at London, the third one down, that one has actually performed the least best out of all of the regions. Albeit saying that, when we look at these figures, it's close to an 8% capital growth in the 12 months that we've done a snapshot here, which in any normal year would be a phenomenal growth. But compared with other parts of the UK, it was actually the least. But therein lies an opportunity, which I'm going to go into more detail as we get into the London property market, and why now may be a very good time to consider investing back into the London property market. So what was it that's really caused this phenomenal growth in a time when many industries have gone in decline and really had challenges? And certainly the beginning of the pandemic, many analysts were anticipating the UK would see a drop in property prices of between 5 to 7.5%. Well, how wrong could they be? Really, as a quick update of what happened, which initially may seem counterintuitive, but has some logic to it. The UK went into a heavy lockdown in late March, early April of 2020. And for 3 months, people weren't able to move. They had to stay at home. This included people working, and it meant that valuers couldn't go out and do valuations. If they can't do valuations, lenders aren't issuing mortgages, and if mortgages aren't issued, people can't complete on their property. So for the first 3 months of the first lockdown, the property market literally ground to a halt, not because there was any fundamental problems with the market, but because of the reasons I've just said. Now, in June of 2020, the first restrictions were started to relax. The government decided to step in to try and stimulate what they thought might be a market that could crash. And they introduced a temporary stamp duty holiday on the first £500,000 of your property, which could save up to 15,000 in stamp duty. This certainly was a great catalyst, but what had happened through the lockdown is that many people were now working from home, and they realized that their home may not suit their needs. And many people needed extra space, maybe an additional bedroom as a home office, access to balconies or communal gardens or close to open parkland to be able to do some exercise in a convenient location. So people were really reconsidering the space they needed. And the third thing was 300 low interest rates. And there's a high correlation between low interest rates and a buoyant property market. But when you couple that with the fact that people were looking at upgrading their property, taking advantage of the stamp duty holiday and the low interest rates, really created an additional surge where we start to see people buying and upgrading their property. And as a result of construction also slowing down with a lower supply coming into the market, the natural supply demand started to drive prices up, and we can see the results in this bar chart here. So let's get into more of the London property market, the capital city, one of the most dynamic cities in the world. And this is just a quick snapshot, but I'm going to focus in on just a few of these as we go through the rest of the presentation. We know that London is a dynamic economy, a major financial centre, but is a very robust economy with a very diverse economy. It's not dependent on any one particular industry. We've seen historically low interest rates, albeit we are starting to see those rise, a phenomenally favourable exchange rate, a huge undersupply in property across the UK, but particularly in London, world-class education. And you might wonder, well, why is that relevant? Well, in London, there's an estimated 500,000 students, and many of these students are renting rooms or apartments, and that's an awful lot of rooms and apartments to rent. It also brings talent to the city, and many students, once they graduate, often stay in the same city that they have studied in, which brings in talent and adds to the economy. The bottom left, we see Crossrail, which is the high-speed rail, which is linking the far east to the far west of London, and will absolutely be a game changer in the speed of which you can cross Greater London. And I'm actually glad to say, after numerous years of delays, there is actually now a formal date. I think it's the 21st or the 23rd of May, but it's later this month, that the formal opening of Crossrail, particularly the central section from Paddington through to Abbey Wood in the southeast, will become operational. Other parts have actually been operational for a little while. So these are some of the things that we'll be going into a little bit more detail as we go through the rest of the presentation. So I've already mentioned that supply and demand is heavily driven by the supply of property coming onto the market and population growth or decline. Now, any city that's going in population growth is always a good sign, because it means that city is attracting people to live in, it's a desirable city to live in, and it's very often because the economy is doing well, there are job opportunities and people are moving to that city. So if people are moving to the city, they need somewhere to live. And again, this puts a crunch and strain on the supply, depending on how many units are coming onto the market. And here we can see that the London population now is at about 8.9 million, and over the next 20 years or so is estimated to be increasing by about 1 million people, which is an awful lot of homes that are going to need to be built, considering there's already a massive undersupply. And here we can see the number of average dwellings or homes that have been supplied each year going back to 2011. The local government estimates that the number of units that needs to be supplied in London is an approximate figure of 52,000 units per year. And again, we can see over the last 10 years that they haven't come close to achieving or surpassing this goal. So again, the take-home message here is that the situation is getting worse rather than better. In fact, they keep revising this figure. 20 years ago, they estimated London needed 30,000 units. 10 years ago, it was at 43,000 units, and now they've revised and upgraded it to 52,000 units. So what's happened in this COVID time is the fact that people have been upgrading, units have been selling faster than they have for many, many years. A limited supply because of construction work slowing down during COVID has created the biggest ratio of buyer demand to supply in over 14 years. Again, putting an enormous strain on the market. Again, great if you are an investor because it continues to drive up prices and rentals. Not so good if you are a first-time buyer trying to get onto the housing ladder. So here we actually see the average price of property in London going back to 1980. And this kind of blew me away when I first saw this, because in my lifetime, going back to 1980, you could have bought an average property in London for £15,000. And I kind of chuckled to myself because if we'd all known where it would be today, I'm sure if we could have, we'd have all been jumping into the London property market and all be multimillionaires by now. But one of the great things about the London property market, it is a safe haven market which has consistently seen growth, and typically every 8 to 10 years has seen a doubling in the house prices. And again, we can see a similar thing in this graph. At 2008, the biggest drop in house prices due to the global financial crisis, but again, a very quick rebound. And we can see in the last year or so, prices really starting to show that they're picking up. And this actually breaks down the different London boroughs. So think of those in Singapore terms as a little bit like the local town councils. And we can see in the centre, the Westminster City Council, the average price of a property is just over £1 million. But if we go further afield into the outskirts, if we look at somewhere like Bexley, an average of £390,000. So there really is a very significant contrast between some of the prime city centre prices to the outskirts and other certain boroughs. So really quite a significant difference there. Now, what we have experienced through the gradual unlocking of the and easing of the restrictions in the UK and more people travelling to the UK is, again, a huge jump in property prices. Now, prime central London operates differently really from the rest of the UK. And what I mean by prime central London is zones 1, which is like the bullseye, if you think of a dartboard, and zone 2 is the next ring around the bullseye. So if our definition is zone 1 and 2 as prime central London, this area is heavily driven by high net worth overseas investors, probably similar people to those who are on the call today. And as these high net worth investors are able to travel again, what we've seen is that prime central London really is starting to rebound back very, very strongly. What we did see since the Brexit referendum was prices across London had moderated. They had really gone up and up significantly, perhaps overheated. And then the referendum occurred, and we did see a cooling of anywhere between 8 to 15% in property prices. But this was a clip from the Evening Standard showing that property prices in August of last year jumped on average by £28,000 in 1 month, which equates to almost £1,000 of capital growth every single day. And again, it's just a reflection that the London property market since Brexit was very subdued. Prices had come down. During the earlier parts of COVID, transaction volume was very subdued. But really now, because prices had come down, international investors and travelers could go back. We've started to see this real great opportunity. And again, other things like the exchange rate. And although interest rates have been picking up, compared with interest rates over the last 30 years, they are still very attractive. Now, here's some other good data that is showing trends in what's happening and how people move around in COVID. In fact, I was just watching on Channel News Asia yesterday. They had something scrolling along the bottom saying that the Singapore MRT is now experiencing about 80% of the capacity that it normally achieved just pre-COVID. We've broken down this to the London Underground passenger usage. So in the blue line at the top is 2019, showing on average each month over 100 million people using the London Underground. In the red, we see in the second month of the year, February of 2020, the lockdown starts in March, and we can see that passenger numbers absolutely plummet and stay there for several months because of the lockdown. As they started to ease, a gradual improvement. And then as we go into 2021, we start to see, again, good steady growth as we go through various phases of restrictions and easing of those restrictions, and a bit of a dip towards the end of 2021, really seen by partly the re-emergence of the COVID additional outbreak of the Omicron, but also for some people at Christmas, staying at home with families and so on, and people on holidays maybe not using the London Underground quite so much. And in the green, we've got the early data that's showing, again, it's starting to climb on a steady basis up to about 75 million. So again, the take-home message is, with the relaxation of restrictions, the UK pretty much has no restrictions these days. With people now returning to the office, we are seeing a return to perhaps a new norm, but more of the normality of people going back to the office. And here, the Heathrow passenger numbers. Again, what we can see in blue is the number of passengers per month. In red, plummeting again, especially at the beginning of the first lockdown. And fast forward to 2022, passenger numbers significantly increasing. And here's a focus in on the London property market really over the last 5 or 6 years. So in 2015, as I mentioned, property prices really had perhaps overheated in London, and we started to see a moderation and maybe what's probably more accurate, a correction in the property prices. In 2016, we see the Brexit referendum, and with that uncertainty, we see a drop in property prices. And as we go through into the 2020, very subdued transaction volume. But as we can see, for the reasons I've already said, in 2021, starting to see a really strong recovery in the London property market. And this really reinforces what Colin was saying from the rental market. We can really see a V shape here. So to the left of this line graph, pre-COVID, we can see where rentals were plummeting down. And then by the sort of early to mid part of 2021, a strong rebound as people return to the office. And this is actually the same as one of Colin's graphs previously, showing vacancy rates, but vacancy rates really are a great indicator of supply demand. And we can see that this represents just over 4,000 properties across London. To the left, we can see on average about 40 units are vacant. So that represents out of 4,000 a 1% vacancy rate. And in the height of the pandemic, just over 200 units vacant. So that represents a 5% vacancy rate. And we can see that going to the far right, we're back to pretty much where we were at about 38 to 40. So again, a vacancy rate of below 1%, which just shows the fact that when property comes on the market, it literally flies off the shelves, and there is just a major undersupply. So let's look to the future now. And this is from Savills, and it's showing the top line, prime central London forecast capital growth. And it's showing that in 2022, the forecast is for an 8% capital growth, and in 2023, a 4% capital growth. So within the next 2 years, Savills are predicting in prime central London, that's zones 1 and 2, an increase of about 12%. And I want you to hold that thought, because I'm going to come back to that when it comes to a potential strategy for flipping a property that you may wish to consider, which I'll highlight a little bit later. This shows the rental market in prime London at the top and prime commuter zones, so on the outskirts of London and commuter belt towns around London. And it's interesting that we see in 2021, prime London is showing a 1% increase in rental forecasts. But in 2022, that jumps to 4.5, and again is reinforcing the forecasting that people are coming back to the office. The UK is returning to normality where people are working from the office, and people, want to be close to their work, and so we're seeing this jump in rental values. When we look at the commuter zone, last year though, 2021, we see that the increase was at 5.5, and what we saw was that if people didn't need to be renting in prime central London because they were no longer working from the office, or it may be that they're just commuting in once or twice a week, why pay 2 or 3 times the rent in prime central London if you don't need to be? You can get more for your bang for your buck. And so we saw a lot of people who were, I call them these like hybrids, who want to be in London, but don't necessarily feel the need to be in prime central London, but paying a more affordable rent, getting more space for their rent, and at the same time having some connectivity if they need to get into central London, if that's where their office is. And this is from Jones Lang LaSalle, so it really just reinforces similar data. If we look at the third line down on the left, prime central London, they're estimating 7.5% capital growth this year and 5% next year. So that's over the next 2 years, an estimation of 12.5% capital growth over the next 2 years. If we look at the top line, Greater London, this year, an average of 6% capital growth. And if we look right towards the end, an average of 4.7. So a very nice, steady capital growth across Greater London forecast over the next 5 years. So again, really encouraging positive signs that the London market after 5 or 6 years has really got some strength behind it and figures that are looking very strong. So let me finish off the presentation tonight with just giving you a snapshot of some of the developments that we have in London. We have in the region of 25 developments across many different parts of London. I've got 5 or 6 projects that will cover a spectrum of prices. So I'm going to start from the most expensive, a real gem of a property in prime central London, and go to the most affordable property that we have in our portfolio, and just sort of highlight some key features and benefits of these properties as a snapshot, so that you can kind of get a flavor of the kind of properties that we have and what might be of interest depending on your budget and investment strategy. So this is the old War Office. It sits just off Whitehall between Horsegasque Parades and the River Thames, and is really a quintessential landmark building, which is going to, I think, change the face of real estate. It's also something that's very close to Singaporeans' hearts in many respects, because it's also going to be a Raffles Hotel there. It will be the first Raffles Hotel in the UK. So almost half of the space will be the most premium, luxurious apartments that will also be serviced by Raffles Hotel, and the other half will be an operating Raffles Hotel. And if you think about going back in time to when the Raffles Hotel opened in the 1800s, I believe, here in Singapore, if you'd had an opportunity to buy into an iconic hotel and building here in Singapore and have your own apartment there, just imagine what the value of that would be today. And really, we have a similar opportunity in a building that is steeped in history. For those of you who are not familiar with the old War Office, it was the main headquarters for the UK during First and Second World War. I think if you go up to the third floor and towards the right, that was where Winston Churchill's personal war office is. That's going to be a presidential suite within the hotel there. Sir Ian Fleming, who wrote the James Bond books, who was also part of the UK Secret Service, used to work there. So a lot of nostalgia and history attached to the building, as well as what you can see from just this one picture, just a beautiful piece of architecture and space to work with for such an iconic real estate investment and established hotel. Now, without giving people too much of a heart attack, the starting prices start from about £4 million upwards. And if you are interested to know more details, again, we're more than happy to have a private conversation. So as we start to go slightly down in price, this development by Galliard Homes, a major developer in London, is in Tottenham Court Road West. So if you want to really be in the heart of the West End, right on Oxford Street, Tottenham Court Road, a 10-minute walk to Leicester Square, Covent Garden, all the theatres and entertainment, and really being in the thick of things in London, you couldn't ask for a better location. From a connectivity point, it actually sits on one of the Crossrail stations. So you are literally on top of a Crossrail station, which, as I mentioned, is the fast high-speed rail, which allows you to connect out to Heathrow Airport in about 25 minutes, or go to the far east of London, again in 25 minutes, and will allow you to be able to really get across London in a fraction of the time. Tottenham Court Road tube station is just a 4-minute walk away, so you can also be accessing the underground and really get anywhere into London. And prices here start from just under 1.2 million. The estimated rental value per month on an average apartment is about £4,500. Part of it is actually going to be completing later this year, and the other part will be completing in Q2 of next year. Now, Graphite Square is a very interesting property in Zone 1, Vauxhall. People may be more familiar with Battersea Power Station and the Nine Elms regeneration area. It is literally next to this massive regeneration area. The new American Embassy is also in that area. And Graphite Square presents a great opportunity to invest both for long-term or a short-term play. Now, what do I mean by a short-term play? There are really two potential investment strategies on a property like this. The long-term play is to buy and to hold maybe for 5-10 years, see the capital growth and enjoy the rental income along the way. But occasionally, when the ingredients are right, there is an opportunity where you might want to look at a short-term play whereby you flip that property. But in order to have a flip, there are some very important ingredients that you require to make it work. First of all, and probably most importantly, is a rising market. And we've seen from the data today that although there's no guarantee that these estimations are correct, we are seeing the early stages of strong growth in the London property market after 5 or 6 years have been very subdued. And the predictions from both Savills and Jones Lang LaSalle are predicting anywhere from 12 to 12.5% capital growth over the next 2 years. Other important considerations are, can you assign the contract? Which the answer is yes. So if you wish to assign the contract before TOP or before completion, that is feasible. having a reasonable runway or timeline before completion or before TOP to give you more time for the property to appreciate. And the completion date for this property is estimated either at the end of 2024 or early 2025. So approximately 3 years away from completion, giving you potentially up to 3 years of capital growth. And if the forecasts are anything to go by, if we're looking at 12 to 12.5% capital growth, then that potentially could give you a very handsome return, especially when you look at the other important ingredients, which is the payment terms. The developer, and this is quite unusual, has offered the opportunity to put a 5% deposit down on exchange, and then 12 months later, another 5%, and then the balance is on completion. Now, to put this in perspective, if I just use a round number, starting prices start from 735,000, but if I were to take a unit at £1 million and you had to put a 5 plus 5% deposit down, that equates to a total of a 10% deposit. So on £1 million property, that's a 100,000 deposit. If the property went up by 10% over the next 2 to 3 years, the property price would then be valued at 1.1 million, which effectively means you've put in 100,000, the price of the property has gone up by 100,000, and you've made 100% return on your investment over a 2 to 3 year period. Now, if you can buy it at a little bit of discount, you can even increase that figure a bit more. And I've quoted figures over the last 2 years of capital growth, but over 3 years, who knows? The estimations potentially could be going up by 15%, which could see potentially 150% return on your equity over a 3 year period, or about 50% per annum. So a different potential exit strategy if somebody wants to take a bit of a punt on a short-term investment opportunity. Okay, we're nearly there, just a couple more slides. So this is 1 West Point. This is one of the other properties that Colin had highlighted during his presentation. If you're looking for an area that's going through massive regeneration and is going to be one of the most important transportation hubs in all of London, if not the whole of the UK, then this really ticks all the boxes. 1 West Point is literally within minutes walk of the London Underground, the Crossrail, and also the HS2, the high-speed rail, which will be connecting London to Birmingham in approximately 45 minutes. So for people who need to be able to travel around both London and the UK and want to have that ease of transportation from an investment perspective, also getting into an area that's going through massive regeneration. And we've consistently seen that properties, when you get in an early stage of a major regeneration, you see a disproportionate increase in capital growth as that neighborhood matures and the value of the real estate in line matures with it. So properties here starting from 559,000, estimated rental values of over 2,100, yields in and around 3.6%, and completion towards the end of this year and early next year. Now, Newmarket Place is in East Ham, in the east part of London. Fairly short ride to places like the Olympic Village, Stratford, Westfield shopping mall, one of the biggest in London. It's just a few minutes walk to the London Underground, and from there you can be into Bond Street, Liverpool Street, into the financial centre within about 20 minutes. One of the reasons I wanted to highlight this property is I think it presents one of the best values of any property that we have when we look at the price per square foot. Now, prices are in and around 428,000 upwards, but the price per square foot, this is in Zone 3 London, and many of the 2-bedroom units we still have available are equal to about 400 to 500 pounds per square foot. Now, if you know London, getting Zone 3 for that kind of price is virtually unheard of. I can't think of another new build quality development, this one by Barratt's, the largest developer in terms of the number of units they deliver each year. a public listed company with an impeccable record. So if somebody's looking for a great investment opportunity with real value for money in an area that's highly go through a great deal of regeneration, you really can't look any further than this one. And we can see that the rental yield of 5% is extremely high for London. We're normally looking at 3.5% to 4%. So I think this really shows you are getting in at a very attractive price relative to the rent. And we can see that that's reflected in the yields of this property. And the last one I wanted to bring to you is Lambton Parkside. This is in Hounslow. And this is a great investment for the kind of owner-occupier or tenant who is one of these, what I call hybrid tenants. They may be somebody who wants to get more value for money or more space by renting, in this case, in Zone 4. The property, as the name suggests, Parkside, is literally right next to a beautiful park. So you've got direct access to open parkland. Each property and unit has its own balcony. And yet it's just a 4-minute walk to Hounslow Underground Station that connects you into central London in under 30 minutes. It's only 3 stops on the Underground to Heathrow Airport, which employs over 100,000 people. And again, will be a great catchment area for people wishing to work either at Heathrow or what I call a hybrid employee who may be working from home 3 or 4 days a week, but popping into the office 1 day a week. We're starting prices from just 275,000, and here yields some of the units as high as 5.6%. So really, if you're looking at a more affordable entry-level style of investment into the London property market, then Lambton Parkside is definitely one to consider. So that brings us to the end of the presentation. What I would like to suggest, and I apologize if I didn't say it earlier, is that we do have a Q&A chat box in the bottom. If you just scroll onto your screen, you'll see a Q&A chat box. If you'd like to put any questions in there, Colin and myself will be delighted to answer and see if we can share some of our knowledge with any of the questions that you may have. So please feel free to put your questions into the Q&A chat box. Let me have a look. At the moment, we don't have any questions, not that I can see, unless I'm pressing the wrong button. Not at the moment, okay. Okay, well, maybe I'll just kick off with one question that's quite topical and on accessing mortgages. Obviously, getting access to finance is a critical part of investing in overseas property. And a lot of people don't realize that you can access UK banks, even if you're a Singapore resident or a non-resident of the UK. We actually work with mortgage brokers who specialize in overseas investors who are based here in Singapore as well, so that you can look at applying for a mortgage, accessing finance. Some of the benefits of accessing finance in the UK is it doesn't impact your TDSR. You can get a higher loan to value, 60, 70, 75, even at a push, maybe up to 80% loan to value. So there are solutions for people who want to be able to access financing and leverage their money with regards investing into the UK property market. Okay, Gary, we've got a first question coming in. Any view on first-hand versus second-hand in London? Shall I start off with that one?
Absolutely.
Okay. I think one of the things that you need to be aware of is, how well do you know the market? Now, One Global, predominantly, most of our stock is in new build property and bringing to market developers' property across London. A lot of it's when it's first launched, it's off plan. We do have projects that are completed. So that's the bulk of what we do. Now, that said, we do have a private office that will do a bespoke search and find properties, typically over £1 million. And we have another partner that we work with that can go into a second-hand sourcing for you. I think the thing just to bear in mind, though, when it comes to the second-hand market is that unless you really know what you're doing and you're able to do your research and due diligence, the potential is that you could make a very expensive mistake. And it may be a property also that requires a lot of attention, may need a significant renovation to bring it up to standard so it can compete against other newer build properties. And so I think the potential for challenges and pitfalls can be sometimes greater when going into the second-hand market, unless you're living there or you're very familiar with the London and the UK property market in general. Colin, do you have anything to add to that?
I would actually second that. In terms of the second-hand market, as we call it, if it was something that you were exploring, I would definitely ensure that you're exploring options of a very well-established development in London. You really would need to have somebody on the ground, whether it be yourself, a friend, or a relation that would be on hand to inspect the unit to make sure absolutely that it's in very, very good condition, that it's a well-established development, that's well looked after as well, because maybe after a period of 5 years, you may not be aware of the type of tenant that was in place. Did they look after the property? Has the owner maintained the capital and rental appreciation on the property and kept it updated due to wear and tear? So I would definitely be doing more homework and background checks before entering the second-hand market in London. I'm not being negative about it, but I would just be more careful and be extra diligent in terms of the checks that you would do. But yeah, in terms of second-hand market, if it's a well-established development in a very good location and supports the lifestyle changes that I spoke about in terms of space, being close to green parks, a larger unit with balcony or terrace, and the yields stack up, obviously, which is important. So obviously you would need to do your background checks, not background checks, but local checks on what rents are achieving in that particular development to make sure that your rental yields stack up. That's my opinion. Just make sure you're extra diligent.
Thank you. Do keep the questions coming, ladies and gentlemen. I know a common question that people ask is, and this is one's for Colin, is what sort of fees are associated with managing an overseas property in London? So Colin, maybe if you can just share the fees.
Fees obviously would be your letting and management fee. If you're a non-resident landlord, you're more than likely going to want a letting and management service. So the top end of the market in London, depending on the agency, obviously, you're looking at a letting and management fee of approximately 16% plus VAT. Obviously, that can be negotiated, but traditionally, the average letting and management fee in London will be anywhere between 10 and 12% plus VAT. The one thing I would definitely say to you and advise is there are agents that may offer less than 10% letting management, but please be very careful in terms of doing your due diligence on the agents to make sure that they're registered with the property management and that their money, your deposits are protected and they're members of all the necessary groups to make sure that they're compliant. Because unfortunately, there are some horror stories out there where landlords may go for the cheaper option, but then the agent is not compliant. They may cut corners in other areas, or unfortunately, there's been instances where the landlords have not even achieved or being passed over their rent. Compliance is becoming very strict. Well, not very strict, but quite strict in London. So please always ensure that the agency is compliant and knowledgeable about compliance changes. One that springs to mind, or two even, is EICR checks, which is electrical inspection compliance reports, and landlord licensing, which is becoming very prevalent in London from the local boroughs. What else you need to bear in mind is service charge and ground rent. That's another charge that the landlord has to pay. You also have to be registered with HMRC as non-resident landlord for tax purposes. But overall, in terms of fees, the large ones would be your letting and management, service charge and ground rent.
And for clarity, the service charge would be the equivalent of like the maintenance fee here in Singapore.
Yeah, correct.
For those who are not familiar with that terminology.
That fee can't be passed over to the tenant. We're very restricted as to what we can charge tenants in terms of fees. And another good point that I'll always make to a landlord is in terms of furnishing, the more you supply in terms of whether it be vacuum cleaners, cutlery, plates, whatever, unfortunately the landlord will be the one that will end up replacing it due to wear and tear. So a good piece of advice is furniture is very important because 99% of the market in London is furnished, but always go middle ground in terms of quality, never go cheap and never go too expensive, but sure, less is more.
Okay. I think that's another important point that people often raise is, can you help with furnishings? Mm-hmm. And when it comes to the developer completing, who's coordinating the handover? Do I need to actually travel to London and pick up the keys? Just talk us through that process a bit.
Okay, so I would definitely recommend that maybe 1 to 2 months prior to completion that you're appointing your agent, and an agent that will possibly, or yes, have an in-house completions team. So the last thing you want is making a decision when you're close to completion to start thinking about letting a management agent. Because if you leave it too close to completion, you're already entering void period. And if you have a void period, it's already costing you money. So I always advise, be ahead of the game, whether it be 1 or 2 months, have your agent appointed, know the rental market, what you're expecting to achieve in rent, then start talking to an in-house completions team like ours, where we will advise you on furniture packages. We'll put you in touch with reputable furniture companies who'll have a range of packages covering all budgets. We will coordinate with the developer, yourself, and the furniture company in terms of getting the furniture ordered, getting it paid for, coordinating installation dates. So it's important that as close as possible to completion, your property is furnished. Depending on the developer, they may potentially let us do pre-completion viewings where we can get access to the development pre-completion. We'll start advertising pre-completion on Rightmove and Zoopla and have a little database of applicants ready to go before completion or immediately on the day of completion. Because in any new development, when there's a release, it will increase volume in that particular area for a little period of time. So you have to give yourself every advantage in terms of, because you are going to be competing against other investors.
Great.
So do all that you can to give yourself every advantage.
Lovely. All right. Thanks for sharing there, Colin. Do keep the questions coming in. I appreciate time is now about 9:20, so we will wrap up soon. So if there's any last minute questions, do please put those into the Q&A box now. Again, just to really reinforce for those people who came in a little bit later, One Global does provide a complete end-to-end service. So if you've been concerned about investing in overseas, really not quite sure about investing because you're not sure, is it a good investment? Who's going to be my lawyer? Can I get access to financing? Who's going to look after my property? Hopefully tonight you've learned that we provide a complete end-to-end service. We will literally hold your hand and guide you through from beginning to end. And what I'd like to encourage is from a seminar like this, that hopefully you've learned something, and that if you are keen on taking the next step, I would encourage to have a call, or better still these days, if you're in Singapore, let's meet up for a personalized one-to-one chat so I can better understand your investment goals. I can then see if those are aligned with the kind of investments that we have. It may not be in London, it may be in another city or even another country, but I can clearly understand your investment goals. And from there, we can create a roadmap of how to assist you grow your wealth via well-researched overseas property investment. So I don't see any other questions coming in. So I think we're going to wrap up. And I want to again thank you for taking time out of your busy calendars to join us today for our webinar. We do have regular educational webinars and exhibitions in hotels. So you're more than welcome to come and join future events, and we'll be delighted to see you. So any other closing comments?
Just one, actually, and it's actually just a report that I just got from Rightmove, which is the largest property portal in the UK. It's just an example of demand in one of our offices over the month of April in East London. Over a total listing of 22 properties on the rental market, we got 1,100 inquiries for the month of April in that one particular office from applicants seeking to rent property.
Amazing.
So, stock levels are low, demand is high, and it's a good time to invest in them.
Great. Lovely. All right. Well, thank
you very much, everybody.
Yep. Thanks, Colin, for joining. And we'll be delighted to see you soon in another event and hopefully in person. So thank you very much and good night.
Thank you.